How do the numbers work when you are utilising principal private residence relief and selling your home into your company? Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. You've decided you're going to be letting your property out and moving into a new house. You're moving house and you're going to be letting out your old home to a buy-to-let or HMO. Great news. But what are the numbers and what are the calculations you need to be doing to see whether it's going to work for you? Well, that's what we're going to have a look at today. So what numbers do we need to take into account? What are the calculations to see whether it's going to be worth it or not worth it, or how much it's going to cost us to actually achieve this process? Let's dive into the numbers and talk our way through what is happening with those, and then we can see what's going to be the right solution for you.
So in our example today, we've got a property that has been owned for 5 years by our person. The current valuation we've got in is of 250,000 and the purchase price was 210,000. So one of the first things we need to think about is our capital gains tax and how much that is going to cost us. Now, in my example, I've just treated it as a single person. However, it may be for yourselves that it is a couple, which will have a slight difference in the calculation as that gain will be divided by 2. So in our example today, we've got a gain of 40,000, and based on that, there will be some capital gains tax on it. Now, because when we're transferring this property into the company name, we are actually going to be transferring property that I've lived in personally, or the person in our example today lived in personally, which means that we can actually do a principal private residence relief adjustment to our calculation to see what is actually chargeable for capital gains tax purposes. Now, check out the video on principal private residence relief to find out what that's all about, and also check out the examples of how to calculate your principal private residence relief to understand what that's all about. In our example here, we've got a property that they've owned for 60 months, which is 5 years, and they've lived in it apart from the final 15 months, which is when it's been rented. Now, the reason that they rented, just to give a bit of backstory, is because they had a mortgage deal that they didn't want to change out of. And many people will understand that, especially at the date of release of the video, because we've had exceptionally low interest rates, which means they don't want to get off that mortgage deal until they have to refinance. Now, one of the nice things about PPR relief, principal private residence relief, is that it says the final 9 months is always allowable for tax purposes, which arguably means that we've now got our 45 months that we lived there and the final 9 months are allowable as PPR. So we have 54 months of the 60 that is exempt from capital gains tax, or we get this relief from capital gains tax. So there's actually only 10% of our gain that is chargeable to capital gains tax. So of our 40,000, we can times it by our 10% to get to our adjusted gain, which is taxable, of 4,000. And then we'll calculate the basic rate or the higher rate tax depending on your personal tax position. I'm going to treat on our example today that this is a basic rate taxpayer, so their actual capital gains tax is actually only going to be 180 when they move the property into the company. Let's move on to some of the other considerations then that we need to be making. And the first one of those is going to be stamp duty. Because the company is buying the property and it's an additional property, there is definitely going to be stamp duty. Now, my summary here doesn't have a calculator for that, so I just go online and use a stamp duty calculator online to find out what the cost is. So for our 250,000 property at the point of doing this calculation, the stamp duty is 7,500. Make sure you use an up-to-date tax calculator to make sure that you're using the stamp duties that will be applicable at the point that you are doing the change from a ownership in your own name to in a company. So we've now got 7,500 that is going to be our cost. The other costs that we do need to consider are going to be those legal fees, because we will need a solicitor, unless you are one, to actually work through and do the paperwork to transfer the ownership. Now, in addition to this, there may be mortgage redemption costs that you do need to consider. So this may be early redemption charges if it is going to still be beneficial when you are transferring. It may be there's just the minimal redemption costs, which are £50, £100, or whatever it may be in your agreements. And the other cost to consider, maybe if you are two people, you may have a second person's capital gains tax to consider, which might actually help reduce it, or it might just manage it to minimise the costs as far as possible. Now, moving down onto our mortgage area of our considerations. So we know we've got an outstanding mortgage balance, and that will depend what you have been paying on probably your repayment mortgage throughout the life of the property ownership. Now, I'm going to work on the basis with our example today that we've got someone who probably got a high mortgage loan to value on the property when they bought it, because maybe it was a bit of a push for them. So on that basis, we've been paying down on a repayment basis, which has now brought it down to 85% due to those repayments. Now, when you go into a company and a buy-to-let or a HMO position, the likelihood is that you're going to have to go to some sort of 75% mortgage plan. And even if you're not, you may want to get some money out to manage that side of things. Now, because the price of the property has gone up over the period, it has taken us the value of the property so that we probably are on a 75% loan to value at this point, or it may have gone slightly more. On this example, I've put in the new mortgage at 75% and the old mortgage is down at 85%. So overall, with the increase in value, when we refinance this property, we're probably going to get out around £9,000. Now, depending on whether you're wanting to take money out of the property when you sell it into the company, whether you're wanting to minimise the loan to value on the property when you sell it into the company, these are all valid options. And this is where you may need to do a bit of playing, tweaking with the numbers to see what is going to be right for you. In our example today, by doing it with the 75% loan to value, we're getting 9,000 out. And the one thing we've noted above is it's actually cost us about 9,180 to actually do this sale. So the actual cost to us physically is going to potentially be around £180. Obviously, probably not quite exact because figures do tweak slightly, but this is giving us a good idea that if we wanted to move the property into the company at the value of the 250, having owned it with all the different costs, it's actually when the end of the transaction has been done, we've paid all the money, and then we've got the money back out of the mortgage, we're probably going to be not far off break even on this. Now, that may be the solution you want to get to when moving a property into a company. So you don't have to pay anything when everything's said and done, and you're getting enough back out again to balance up the books. And that might work perfectly for you. For others, it may be you want to reduce the loan to value, which means it may cost you to move things into the company. It all depends what your end goal is with this aspect of things. Now, let us move on to your new property, because we have a few considerations, because this is a property that you're moving out of and you own it. So where are you going to be going? Now, it may be you've already had it rented out, like in our example, so we've not got a problem. You've got somewhere else that you've already purchased and have moved into. But for that new property that you've moved into, you need a deposit for that money. So there is extra money that you need to pull together to enable you to hold on to that property. We've also got an extra loan, so there's actually now less equity in that property than there was before you sold it into the company. So it's just some of these considerations to make. Now, because you've still got this property in your own name, there is obviously going to be additional costs on that new property that you've got, because we're now going to have to be paying the higher rate of stamp duty. And this is going to be at the normal rates plus the 3% that you are paying. So that means we are now going to be paying, rather than the 5,000 of stamp duty for the property that you'd normally pay if you only have one property, you've now got 15,500 that you are going to have to be paying. So this is obviously a 10,500 difference So there is some timing issues you may need to be considering now, because if you sell that property in your own name into a company, for example, or to someone else, you're going to be able to claim that 10,500 back as long as that is within 3 years. So there's a few considerations to be making if you are looking at selling your property into a company, especially if you've got additional stamp duty that you are having to pay on that second home that you're going to be moving into. As you can see here, we've gone, the person's upgrading their property, so they're going from a 250 property up to a 350 property. They need a higher deposit of maybe 70,000 or 87,500, and we've now got stamp duty to be paying of potentially 5 or even 15,500 because of it being a second property. This ultimately means that now our cost to get into this property, excluding our deposit, are now at 9,180, which is what we needed to, in essence, do the transfer, as well as then the additional stamp duty that we are now paying on that property, plus the deposit, depending what a deposit you need to pull together. So here we are before the deposit at around 25,000. But this isn't the final end cost, because obviously what we're going to be getting back is the money out of the mortgage and also that 10,500 refund of the stamp duty we've overpaid, as long as we have sold it into the company within 3 years. So that means the end cost for us is going to be that extra stamp duty and the costs that are not being recouped from the refinance into the company. So overall, we're just over £5,000 to get into it, plus the deposit that we are going to be leaving in the property we're buying. This leads us into the bigger picture, and hopefully you can see that there are quite a few numbers. And here is the scope of all the different numbers that we have just talked our way through. And depending on the timing, we'll alter, we'll tweak, we'll change, depending on valuations of properties, mortgage loan to values, and the cost of the different capital gains tax rates. So you can do this sort of calculation to plan what you may do, and you may need to update it with what's actually happening in the world around you when it comes time to actually make those changes.
As you can see, there's a few numbers that we need to consider, and all of those numbers may be a continually changing set of numbers as different things are happening. For example, your early repayment charges may be going down, or they may go up, or you might not have to pay the extra stamp duty if you do things in a specific order. So there's quite a few things that you may be altering as you go through the numbers as your situation changes. But hopefully that gives you a good idea of what numbers you need to be looking at, how to put them together to assess what is going to be the right solution for you and your family. Hopefully today you've discovered how you go about calculating those all-important numbers to figure out what you have to do to make sure that the transition from selling your house to your company is going to work, and how it works for you specifically. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing.